Welcome to the Real News Network. I'm Paul Jay in Washington. Most central banks around the world preach fiscal discipline. Inflation is their biggest concern, and even when they do enter into some stimulus policies, the final objective is still the issue of lowering debt. Well, one central bank in the world apparently has a growth agenda, and that's in Argentina. Now, joining us to talk about this is John Weeks. John just was in Argentina not very long ago. He's a professor emeritus at the University of London School of Oriental and African Studies. He's the author of the book Capital, Exploitation, and Economic Crisis. He runs jweeks.org, and he now joins us again from London. Thanks, John.
Thank you.
So what did you make of what the central bank's doing in Argentina?
It's tremendously important because in the 1990s, Argentina was the epitome of a neoliberal monetary policy. It had something called a currency board, and that a currency board involves taking the foreign exchange you hold, which is, in the case of Argentina, dollars, and that your domestic money supply is rigidly tied to the amount of dollars you hold. Of course, the amount of dollars you hold is a result of your imports and your exports, a balance between the two. And so, in effect, you had no independent monetary policy, and it tended to be quite deflationary. That is, it tended to be cause not only very low inflation, but actually negative rates and also very slow growth. At the end of the 1990s, the disaster that policy had inherent in it was realized. And in 2001 and 2002, suddenly Argentina could no longer maintain that policy, because what it meant basically is that if you began to lose dollars because you were Argentina was running a trade deficit, it meant you had to contract the economy because you had to take your domestic currency out of circulation, more and more of your domestic currency out of circulation. And that led initially to a severe recession in the economy. When that could no longer be maintained, and they temporarily went off the currency board, you had hyperinflation for a year. Okay, the current government of Cristina Fernandez has repudiated that policy. They have introduced a new central bank law. They had actually been practicing it, but they formalized it in this last March, just 2 months ago, which completely ends the currency board regime and replaces it with a central bank that facilitates a growth-oriented policy of the government. And it also is concerned about inflation, but inflation no longer becomes a constraint or the tail that wags the whole dog.
So how do they do that?
Yeah.
So what are they doing exactly?
Well, the economy has grown very rapidly since the end of the currency board. It's grown at about 7% since the currency board collapsed in 2002. That has been brought about by the flexible monetary policy, which was allowed within the confines of the old rules, but was not sufficiently flexible to be sustained, but primarily through a government which pursued a policy of active fiscal policy, expansionary fiscal policy, combined with public investments in infrastructure.
Okay, well, what does that mean by flexible monetary policy specifically?
Well, what it means now is that an inflation targeting policy is what most governments in Latin America, well, no, that's true. Venezuela doesn't, and nor does Bolivia. But many governments in Latin America, and of course the dreaded European Central Bank follow. That means you set an inflation target, usually a low inflation target that happens to be 2.5% in Europe, and then If it appears that the economy is going to exceed that rate, then you rein in the economy by using the central bank interest rate, by making it harder for businesses and for individuals to borrow. So that in effect means that you're compressing the economy, reducing the rate of growth in order to keep the rate of inflation down. A flexible monetary policy sets the rate of inflation consistent with a growth target. That would be the simplest way. So instead of having an inflation target, you have a growth target. Say you have a growth target of 5%, for example. Then it becomes a question of how much inflation you're going to allow with that growth target. And in the case of Argentina, the government has been prepared to allow an inflation target upwards towards 10 to 15%, though it hasn't been that in every year. In most years, it's been well below that, on the argument that it is more important for people to be employed and for them to have rising incomes and to have incomes that are rising faster than the rate of inflation. So their real incomes are going up. So with their real incomes going up, you can live. You don't have to have a 2.5% or 3% rate of inflation, because you have a real economy expanding, so your money wages are expanding faster than the rate of inflation.
So the argument one hears against this is that it gets out of control and inflation starts growing faster than real wages, so there's no real advantage to workers. That's the argument that's given.
Yeah, that's the argument, and says, yes, a little bit of inflation leads to a lot. I would say that's similar to saying conventional war always leads to nuclear war. Rapid inflation, high rates of inflation are an entirely different phenomenon than what we're talking about. Rates of inflation of 0 to 25%, all empirical evidence shows that rates of inflation from 0 to 25% do not lead to hyperinflation. Hyperinflation results when there's some terrible breakdown in the economy, such as in another interview I was talking about Greece. If the Greeks were to abandon the euro, they would get hyperinflation, because all of a sudden the whole institutional framework has changed so dramatically. Right? I'm not in favor of 20% inflation, but I'm in favor of growth. And so the question becomes managing inflation in the context of growth, not managing growth in the context of inflation.
So what are the numbers in Argentina then? What is inflation, and are wages keeping up with it?
Wages are keeping up with inflation. There's considerable debate about what the current rate of inflation is, not less about what it's been in the past. The critics of the government say that the rate of inflation is about 25%. The government says it's about 15%. This is partly a question of how you measure it, and whether you want you're measuring low incomes or high incomes, or GNP as a whole. The central point is not the exact rate of inflation, but the fact that the economy is growing and real incomes are growing. That is, in real terms, when we say real terms, what I mean by this, how much is being produced, the goods and services being produced, the real things people are consuming, the amount of food they eat, the amount of durable goods they can buy are going up. And this is true of the working class and of the middle class. And that's partly, I should say, the result of the government's taxation policy to prevent inequality from getting out of control. But let me try to put this slightly in context. So you asked me, you said that the argument against, and is quite correct, against permitting or tolerating a certain degree of inflation is further along the road, you're going to come to regret it, because inflation will go faster than wages, and then there'll be a declining income. Turn that argument around. If you pursue low inflation, you have low growth. You can never recapture the growth you missed. You know, if you're in a country that this year grows at 2%, when it could grow at 4%, you'll never get those 2 percentage points back. And if you have unemployment, as in the United States, of around 8%, and you could have unemployment down around 5%, that 3% of the workforce that's unemployed this year, they will never get this year back. So it's, I think, raising the question of what is foregone as a result of allowing inflation is completely spurious. The real question is, what do you forego as a result of having low growth?
Now, the other argument against this is what happens to people on fixed pensions. In Argentina, are pension rates being raised at the same level as inflation?
This is a somewhat complicated question because they're public pensions and they're private pensions. It's difficult to pursue them all. But basically, the answer is yes. You do, they are. But I think again that is a spurious, to a certain extent, a spurious argument, because the real people who gain from a low inflation regime are the banks. And they are the losers usually in a high inflation regime. So those people on fixed pensions are brought forth as an argument by the right wing in order to say, oh, we're not arguing for us. We're arguing for the little old ladies, you know, that have to go down to the market and make their pennies and make their pesos go so far. And inflation, sure, inflation undermines people's expenditure in the sense that it makes things more expensive, but you can deal with that if the economy is growing. You can deal with it by raising the state pension. You can do it formally by indexing, or you can do it a bit by bit. You can index wages. In the case of Argentina, they have not indexed wages, but they do it through national bargaining. So they're mechanisms of dealing with moderate inflation. If you have slow growth and you have unemployment and you aren't prepared to reduce unemployment, there's no way to deal with that except to pay poor relief.
Thanks for joining us, John.
Well, thank you.
And thank you for joining us on the Real News Network.